All right, welcome today to our third cryptocurrency fund workshop. And today we'll be discussing the tax aspects of launching a cryptocurrency fund. And the first two funds, presentations that we had were focused on marketing a fund and knowing when it's time to start a fund. Now we're going to get into some of the more technical aspects of starting a fund, and some of that involves other service providers. So we have Ian, Gobin, and Eric, Essian. So Ian is with Harneys, and Harneys is an international law firm, and they focus on the Cayman Island, BVI, and other offshore jurisdictions. And so we work heavily with Harneys, and we're excited to have them with us. There are a couple other colleagues of Ian's here today, and they will be discussing the master feeder structure, briefly the mini master structure, and the side-by-side structure that are most commonly used in startup hedge funds. And then we'll talk about some of the issues that are unique to cryptocurrency funds. And so Eric's practice at Richey focuses on the audit side, and we have been working with Richey for many years, I think back to 2013, with setting up our funds and auditing our fund clients. So glad to have Ian here, and he'll be specifically talking about the cryptocurrency side of taxation of private funds, and how we need to navigate the tax issues. And then finally, Chris Rogers, who is our capital fund law tax partner, and Chris has formed over 200 investment funds and structured funds, both offshore and domestic, and we'll talk about some of the structuring issues that we would encounter and that we would look at specifically for cryptocurrency funds. So we welcome you, and appreciate the individuals that have sent in questions, and we'll answer a lot of those questions today, specifically those that deal with tax, and we'll get back to you individually or send out a email to the group to answer questions that are unrelated to tax, but that are important when setting up a fund. Now, on Thursday, we'll be doing a presentation not through capital fund law, but through a nonprofit that we have founded together with a number of service providers and students at Harvard University and Brigham Young University. And the Global Center for Investment Fund Studies will be having its kickoff meeting. That one will also discuss private cryptocurrency funds, and we'll talk about some studies that we're doing that focus on how to democratize the capital raising process.
Good evening. As John has already said, I'm the partner at Harneys in Grand Cayman. I run the investment funds and fintech group. I've been offshore now since 2001. The way in which we have been structuring cryptocurrency funds now, we set up our first cryptocurrency fund over 3 years ago, and then it was unheard of. I remember the associate that came in who had the call, and it was the strategy was purely to buy Bitcoin, and we were sort of stunned at the time, sort of thinking, the strategy is what? They're just going to buy Bitcoin, that's it. And sure enough, it was just buy, hold. We only wish we'd invested in that fund. We would have done very, very well. Sadly, we didn't, and that's why I'm standing here today. The way in which the market has evolved significantly, and it amazes me that it does so every single day, and that's largely why I like working in this space, because it is just so innovative. But investment strategies have significantly changed since 3 years ago. Now we are seeing very, very complex investment strategies around cryptocurrency funds. Yes, you will generally see an element of purchasing the sort of mainstream currencies, but then the investment strategy will very much sort of go into investing in ICOs, investing in pre-funding ICOs, investing in blockchain companies, and then particularly with the sort of hedge fund aspect of the crypto funds, and the fact that liquidity is key with these structures. We've really got to work very closely with the manager and also with US counsel to just work out how liquid these portfolios are going to be. So where we see open-ended funds being set up in this space, they generally will be regulated by the Cayman Islands Monetary Authority. The typical terms would be, for example, there'll generally be a 1 or 2 year lockup period during which time investors will not be able to redeem out of their interests. That really gives the manager a chance to put the money or crypto, if it's been in subscriptions in kind, to work in accordance with the investment strategy, so people can start really seeing the returns. After the 2 year period, that's when we generally sort of see redemption rights being quarterly. You can have whatever you like, but quarterly redemptions seem to be what people are adopting mostly. Side pockets are key. Side pockets were a useful tool pre-financial crisis, but then during the financial crisis, I would sort of say there were managers that were abusing the concept of side pockets. That the concept being that if investments that were made suddenly became illiquid, you could move them into a side pocket, which meant that if you were redeeming out of the fund, you didn't redeem your interest in the side pocket until they were realized at a future date. So that worked really well. Then when the crisis hit, people didn't necessarily, that they wanted to move illiquid assets into the side pockets. And they were abused over time, so they completely fell out of favor. And indeed, if you're setting up a fund now, which is non-crypto, you're generally not going to have side pockets. Crypto, all things change. The open-ended funds absolutely do have side pockets, and they're disclosed. Often a percentage of what's being invested will be disclosed as potentially that is where we'll invest in the more illiquid part of the investment strategy, and they will go into the side pockets. We generally see Cayman master feeders being set up. We generally see that both the master and the feeder being corporate entities in Cayman. The reason that we have the master feeder, and then there'll be a Delaware entity set up by US counsel. You're going to have the US taxable investors go into the Delaware structure. You're going to have US non-taxables go into the Cayman entity. Now, talking about that, the reason you would have the US non-taxables going into Cayman is because they're generally endowments, pension funds. Now, right now, we're not seeing those institutional investors get into this space. It's a matter of time, but right now, with the various issues that exist over custody, over some AML issues, and just a general sort of, they're not comfortable yet in this space, it's not happening. But the reason that the Cayman entities still exist in these structures is the rest of the world wants to invest. And they do not want to be investing in a Delaware entity that would bring them potentially onshore from a tax and regulatory perspective. So they're choosing Cayman, or indeed they're choosing BVI as the vehicles of choice when a manager is looking to set up a crypto asset fund. I would sort of say, right now the way in which the sheer volume of calls that we're receiving and have been now for quite some time is aggressive. even mainstream managers who have been very, very comfortable setting up long-short equity funds for many years. Pretty much every call we receive now, even for a manager, mainstream long-short equity fund, they'll drop in at the last moment, and we're going to just set in, going to establish a crypto sleeve in the fund. We go, wow, wasn't expecting that. When we do that, there are other service providers that we will start working with, and also if the manager is looking to bring in crypto subscriptions, there are solutions around that. They're pretty new, but so that's when we'll start bringing in additional service providers to help out the mainstream fund administrator deal with the KYC and AML processes that will be required to really sort of go into the crypto that's being used as a subscription, to check provenance, to check everything in respect of the subscriptions that are coming in. It's incredibly important for the manager from a reputational perspective. It's incredibly important for every service provider to work incredibly close together, probably far more so than a mainstream fund that's being set up. The spotlight is on this space. Everyone's going to be working to their absolute maximum to make sure that everything is set up just the way it needs to be. And things change daily. There are many sort of issues that exist in this space, be it custody, be it banking, be it AML, but every day there are also solutions that are coming out. I'll leave it there for the time being.
All right, thank you, Eric.
How's everyone doing? My name is Eric Essian. I'm a tax manager. I work at Richey. It's an auditing and tax firm based out of Denver, Colorado. I currently sit in Charlotte. Starting probably this past fall, we really got a lot more active in the crypto space, in the actual audit and taxation of these funds. Basically, my role is to kind of be the lead on the tax side. We're making sure that from a fund perspective, all of the regulatory issues are being complied with at the federal and state level. So a few of the main issues that we've been dealing with a lot of these new funds that are launching relate to kind of threefold. The first being the applicability of Section 1031, like-kind exchange. The second being, hey, are all of these transactions we're making actually taxable? What's the tax effect of these? How is this treated for tax through the eyes of the IRS? And the third being for people who are just kind of launching their fund and trying to raise capital. Hey, we have all of these new investors. They don't want to contribute cash. They want to contribute crypto into the fund. What is the, tax effect of that, both to the fund and to the investor? As far as IRS guidance goes on the taxation of digital assets as a whole, there hasn't been a lot released yet. In March of 2014, they came out with a notice, 2014-21. It's basically, it's 2 paragraphs kind of saying the viewpoint of the IRS of how these should be treated, as well as in FAQ section, they answer 15 plus questions that you may prospectively have as it relates to the taxation of crypto. And basically what that notice says is that yes, trading in crypto, investing in crypto is a taxable event. The tax effect of it really depends on how you are either obtaining crypto or investing, trading crypto, and whether or not that is considered a capital asset in the hands of the holder. So for the most part, if you're buying into Bitcoin and holding it, hoping that it appreciates, that's going to be capital in nature. It's going to follow the same rules as a stock would. So just goes off holding period. Anything over 365 days is long term, under 365 is short term. If you're actively mining it, that is ordinary in nature. And so as you're mining it, you'll just take the fair market value of the coin as you receive it, and we'll treat that as ordinary income, subject to just marginal tax rates on your personal return. That's from an individual perspective. Obviously, funds are flow through in nature, so the funds themselves aren't being hit with a tax, they're being flowed through to their investors. There are some unique circumstances involved with the taxation of this. You're starting to see some chain splits, hard forks, airdrops. This is starting to get a little into the hazy area of taxation. For our purposes, we're kind of treating most of those situations, again, as ordinary income as you receive the coin. And if you hold it and there's any additional appreciation to the coin, then it's going to turn into that capital regime. So overall, that notice is kind of telling you that these coins are intangible personal property, but besides that, the IRS hasn't really provided a lot of insight on the taxation of these. With the advent of new tax reform that came into place January 1st, there's been a lot of questions being asked about the applicability of Section 1031. There are certain firms that previous to January 1st were more comfortable with accepting Section 1031 treatment. It's like kind exchange, crypto to crypto. Basically, they're saying it's not taxable. Specifically at Richey May, we've always been more on the conservative side and called that a capital transaction, whether selling these coins for USD or exchanging Bitcoin for Ethereum. That's all going to be capital. Section 1031 was a three-pronged test prior to 2018 that included personal property. That's where the question came in. People are saying, okay, crypto is an intangible personal property based on the governance that the IRS provided. Why is 1031 not applicable? Other firms would say file an 8824, which you use to file all of your like-kind exchanges. File an 8275, a disclosure statement, just to kind of cover yourself in the event that it is going against the regulations of the IRS. Call it good. Starting January 1st, tax reform section 1031 has been updated. It no longer applies to personal property whatsoever. It's only real property now, specifically real estate. So that question has kind of gone away for any activity occurring after January 1st. There have been people asking that they had these exchanges take place in December of 2017 that haven't closed yet. So they're trying, you saw a lot of activity in December, November, trying to close these exchanges before the new tax reform law came into effect, because there was a strong belief that 1031 was going to get changed, and it did. The last big question that we have on kind of the tax side from a compliance standpoint is contributions in kind. We have a lot of people who are trying to defer their tax liability as long as possible. So they're basically trying to take all of their coins that they purchased 3 years ago and contribute them into a fund and have that tax be deferred until those coins are ultimately sold. The tax treatment of contributions in kind, generally from a partnership perspective, contributions in kind are tax-free. There are specific exemptions or exceptions related to hedge funds. Basically, if you are contributing in kind to an investment company, which is any company where 80% or more of your assets are deemed readily marketable and held for investment, that is one of the two tests to make it a taxable event. Second test being if you contributing your property is resulting in the diversification of that property, that is going to trigger a taxable event. So if you're contributing one coin into a diversified fund, the IRS views that as a deemed sale. They're saying you're now diversified. It is now, in the eyes of the IRS, that's a transaction, you're going to be paying tax. I guess some of the things to look out for with contribution in kind is just the allocations that go along with that. Basically, if you contribute in kind and it's non-taxable upon contribution, you're basically contributing with a built-in gain. if you contribute something for $10 and it's worth $1,000, that $990 is still going to be taxable to you. It's just going to be kicked down the road a little bit. So let's say that coin is sold 2 years after the fact. That $990 is going to be directly allocated to you, and any additional appreciation on that coin is going to get allocated evenly out to all the investors. So basically, I guess to kind of wrap up, we're seeing a lot of our clients ask questions about how can we defer this tax? Is this taxable? Do we have to pay tax on this? I think in 2015, only 800 or so people actually filed taxes on their crypto transactions, and there hasn't been a huge push upward of that, but the IRS is definitely, as you may have read in the news, they're going after Coinbase, asking for customer information. They're definitely on the forefront of regulating it, and they're also very well known for retroactively creating rules. So we believe that conservatism in this space is key, because I don't think anybody wants to go back 5 years and have to amend every return they've had at the fund or as an individual. So.
Great, thank you. All right, Chris.
Good evening. My name is Christopher Rogers. I've been I'm a partner, tax partner with the firm. I've been with the firm since 2012. So I've worked very closely with John and worked on, as he said, a number of funds, both structuring them legally and from a tax perspective. And as we've seen recently, the SEC has come down in the space of crypto and start regulating more. The CFTC has come in the space of crypto and regulated more, and the IRS and the tax laws have also come in and started not only regulating more, but there have been some bigger moves to hedge funds in general with the recent tax law changes that affect not only crypto funds, but many hedge funds in general. And as a result, in the beginning of this year, we started seeing a lot of questions. A lot of these questions were regard to structuring based on the changes in these tax laws, specifically the fact that the corporate rate was reduced substantially from the previous 35% down to the 21%. So there was a number of calls that we were fielding saying, well, what about now changing the historic structure that we've seen in most of our domestic funds, from this Delaware Limited Partnership to an investment management company that's an LLC and a potential general partner that's an LLC, to maybe some of these structures being now corporations to take advantage of some of these taxes. In addition to the rate change, there was what many hedge fund managers may not be aware of. There was a significant change in the applicability of the long-term capital gains rate. Previously, as Eric had talked about, long-term capital gains applied to assets that were held more than capital assets that were held more than 365 days or 1 year. Recently, those changes went from 1 year now to 3 years. And so some midterm funds that were generally holding between 1 and 3 years in their assets could now potentially be subject to short-term capital gains, which is a much higher tax rate than their long-term counterparts. One of the exceptions that came across with these rules and the changes in the holding period was that, again, corporations were not subject to that same holding period. Corporations, the holding period remained at 365 days, or the 1 year mark. So based on both of these specific issues, there was a big wonder about the change in any of the structure and whether or not that would be beneficial to particularly managers. and holding
Chris,
companies.
make sure you explain that we're talking about the carried interest only. Where this doesn't apply to all investors, but just the carried interest for.
The carried interest for the investment managers themselves. And so, as a result, we had a number of questions that came in, and what happened is when we started looking at the issues, there were a number of issues that arose in determining whether or not a general partner structure should be changed to a corporation. One came in the fact of, well, maybe if I do it as an S corporation, I still get the pass-through that we can use, but I get the corporate structure that allows for the reduced holding period. Well, the IRS came in, they saw that, and recently in March said, no, we understand that the rules may just say corporation, but we're going to interpret that to include also S corporations. So that went out. And so one of the basic issues was this difference in that taxation, because the flow-through nature of the LLC partnership structure that would be taxed at a higher rate, the individual rate, and this lower structure, the corporate structure that allowed for the lower rate, made kind of this difference. But one of the things to note in the corporate structure that the IRS has in place and that many managers may not be aware of is what's called an accumulated earnings tax or personal holding corporation tax. And what that is a specific tax that the IRS places on earnings that are accumulated or held in a personal corporation that are not distributed. That tax is approximately 20%. So the idea of potentially holding this income and not distributing it to a later date could still subject the managers to potential additional tax, although they haven't made the distribution. The IRS has gone through and they have issued some chief counsel advice that for certain holding type companies that don't have additional employees, don't have additional responsibilities other than receiving this potential carried interest, that threshold for the amount of what could be considered above the needs of the corporation, which is the standard for the accumulated earnings tax, could be very low, and as a result, any of this excess income could be subject to that tax. The way to avoid the accumulated earnings tax, obviously, is to distribute the profits, and as the managers of these corporations would then receive these as dividends, which is also subject to the 15 or 20% dividends tax. So when comparison of the two structures, the lowered individual rate down to 37, and if you're starting to distribute these profits to avoid the accumulated earnings tax, the difference between the two has now become relatively small, if negligible at most. On top of that, everybody was only looking at the federal income tax results. They weren't necessarily looking at also the state tax components. There are a number of states that we know of that have zero personal income tax, which means on a flow-through, they wouldn't be subject to any additional taxation. But many of these states still have 5-10% corporations tax, which means that income in a corporation would also be subject to that tax, to that state tax. So looking forward, what we're seeing is, although these tax rates changed and these holding periods were also changed, there still hasn't been a large shift towards these general partnership entities in the limited partnership structure being deemed corporations. However, each now, because we're looking at the holding period of the assets, we're looking at the location of the manager, and we're looking at the strategy as a whole, has made it not so clean as to saying yes or no. So each case is now done on an individual basis. So, so going forward, that's we don't foresee a big shift unless there are some additional tax complications or additional tax changes in the law. But we take everything now on a case-by-case basis, and we talk to our individual clients. Thank you.
Great. All right. Thank you. All right, and thank you to the panelists for giving us that overview. So, with this cryptocurrency fund startup workshop series, what we're looking to do is provide a general overview of the various aspects of forming a fund. And at the outset, the question of when to form a fund and when a fund manager has sufficient capital to raise the fund leads to the next question: is how do you know how much capital is you can raise? And that goes into marketing. And last month we dived deeply into the marketing aspects, the marketing laws, how they differ from state to state, and then the next area that we would lead a client to when discussing the setup of a cryptocurrency hedge fund would be structure. And structure is almost entirely driven by tax. The reason that we're looking at setting up a fund in the BVI or the Cayman Island is based on tax needs of the investors. The reason that we would use a Delaware limited partnership with a separate management company in GP in large part is driven by tax. And so as we talk about the structure, it's important to at least have an overall understanding. Maybe you're not completely able to footnote everything that the panelists said here, but at least have the overall understanding that this is a flow-through tax environment. We're looking primarily for flow-through tax treatment. We're looking to set appropriate structures in line with where your investors are located. So if you've got an investor that is set up in offshore, that we need to look at doing a structure that would block that taxation from affecting that investor. If we have investors not so much for cryptocurrencies right now, but when you've got institutional level tax exempt investors, including RIAs that are investing, we need to look at whether it's appropriate to set up a master feeder structure offshore, and that usually would be triggered by leverage. When there's leverage on a portfolio, that creates UBTI. Again, we try to steer our cryptocurrency clients clear of both using leverage and the reality is it's very difficult right now for a tax exempt investor to invest. So with that overview, let's turn to some specific questions about the tax aspects of forming and operating a cryptocurrency fund. And before we get started on that, Vanessa is our associate in our Los Angeles office. She's going to come around with a mic, make sure that you clearly speak into the mic for the benefit of our our webinar audience. And then make sure to hold it down just a bit. It's a bit sensitive. Okay.
Thank you so much for this truly diversified panel today. That's a model of diversification, talking about that. One question with two ramifications for Ian and Eric. Assuming it's a cryptocurrency fund in BVI, very often that's probably a Reg D fund, and if it's liquid holdings, assuming there's nothing, as we know in Reg D, that can stop the manager from actually agreeing quarterly redemptions. The first question is, of course, quarterly redemptions will trigger tax events. Will they be actually distributed on K1 forms at the end of the year proportional to all the holders corresponding to the shares they hold? And related to this is, how about trades which are done in such a Reg D cryptocurrency fund? They trigger capital gains tax. Are they actually all passed through K1s proportional to the investors in the fund?
Thank you. Eric, do you want to
Yeah, I
tackle that
can
one?
speak to that. I assume that this fund in BVI is checking the box to be treated as U.S. partnership. That would be really the only case in which K1s would be distributed. So we'll just call it checking the box, BVI fund. To answer your question, yeah. So any of the trades that occur during the year, it's going to trigger capital gain, and that at the end of the year, 12/31, is going to be allocated out pro rata based on ownership percentages of the fund of the investors, and that's what's going to show up on your Schedule K1.
And the redemptions will also be treated through K1s as...
So I think there's a little bit of confusion. Redemptions themselves aren't taxable events. The taxable events is the actual activity that occurs in the fund during the year. We see that a lot of people, especially in the crypto space, they may have invested $10,000 into a crypto fund at the beginning of 2017. What's it worth at the end of 2017? $200,000. Like they just, and that's all realized gain. So that individual themselves is on the hook for $190,000 of capital gain. They might not have that in their bank account just sitting at home. So that's when the redemption from the fund is necessary. The actual redemption, just getting cash out of their investment, that in itself is not taxable. It is what occurred during the year to go from $10,000 to $200,000.
I should have said from the point of view of the portfolio manager who needs to sell securities now, actually, to give cash to the person that's redeeming.
And Vanessa, would you just make sure that...
Sorry. So from the point of view of the portfolio manager of the crypto fund, I should have specified, who now is faced with a quarterly redemption completely compatible with Reg D. He actually needs to give back cash to the investor, so he needs to go and sell cryptocurrencies. He's actually triggering realized gains and losses in the portfolio.
Yeah.
So those realized gains and losses triggered by a redemption, are they actually passed through at the end of the year? Sorry, I used the K1, it's inappropriate for BVI. But how are they passed through to the investors? Who pays tax at the level of the portfolio manager for the trades done to satisfy the redemptions?
So I can't speak specifically to the rules of BVI, focus mainly in U.S. taxation. So, I mean, for the most part, my understanding is BVI, there are no taxes, yeah.
No taxation?
No taxation in Cayman or BVI.
So if I rebalance a portfolio in BVI, change the portfolio, no taxations?
Well, the taxation occurs onshore in terms of where the assets have been purchased. So it's more of an onshore issue than it is an offshore issue.
Okay, and they are distributed through K1 partnerships now onshore, is that it? I'm sorry, perhaps I didn't explain. I'm in BVI. I run a cryptocurrency Reg D fund. I agree with the investors that quarterly I will be satisfying their redemptions, perfectly compatible with Reg D. Now someone wants 1 million redemption. I need to go and sell cryptos to give him 1 million back. I'm creating realized gains and losses. Who is paying for those realized gains and losses? To which are those taxation events being passed to? Through me as a portfolio manager, or proportional to all the investors in the funds? Or you're saying in BVI, when I'm selling cryptocurrency, realizing gains and losses, there's no taxation? Probably not.
Are your investors U.S. investors?
No, offshore. BVI, offshore.
Okay, so it's a BVI fund with all offshore investors.
Yes.
In that case, there's not really going to be any U.S. taxation ramification.
Yeah, you'll need to look to the local jurisdictions to determine the
Well,
taxation
so there's no taxation anywhere?
issues. So, yeah, and maybe we can talk more about this afterwards, but.
So you're saying in a BVI offshore, in a Cayman funds, offshore cryptocurrency fund, Reg D, any trades that take place, there's no taxation?
And that's less, the issue is.
Yeah, and it's for you, I mean, it's your.
There are no taxes in the Cayman Islands or in BVI.
Okay.
Now, in terms of the trades that are being made, whether they trigger taxes in other jurisdictions, I cannot speak to that.
Oh, I see.
Okay. All right. Anyone else here in the live audience?
Hi, thank you all. I had a question in terms of, in this area, is there a difference of where you set up your office or your headquarters, whether it's in Connecticut, New Jersey, or New York, and what are the key considerations there?
All right, so maybe I can speak to that briefly. So we get this question a lot. Vanessa, you want to slide to the side? So we get that question quite a bit of fund managers wanting to know where they should set up their management offices, and generally looking to the non-tax issues, looking to the Investment Advisors Act. When you have a client, investment fund client that has less than 150 million in assets under management, then it becomes very important where that fund manager is located, because depending on the state in which the fund manager is located, they can have the requirement to take transaction-based compensation, performance compensation, that is, solely from qualified clients. So they're going to be governed by specific provisions of the Investment Advisors Act. And so there can definitely be ramifications where you're located. That can go from, on one side, full registration, in which case with cryptocurrency funds, that becomes problematic because full registration would trigger some direct on-point issues relating to custody. So it does matter, but the question that you're asking is a question that I hear a lot is, where should I set up? And the reality is it matters very little where you set up. It matters where you are performing your services, where you live. If we could choose a jurisdiction, we'd all go to Wyoming because they don't have an Investment Advisors Act and they are very loose with their registration. But the state in which the test is, where do you live? And if you have multiple managers, we can talk about it, but it has to do with the activities. So from a legal side, it matters where you're set up. From a tax perspective, and correct me if I'm wrong here, but we're looking at flow-through taxation of the managers, and so of course there are going to be different structures, but again, that goes to your tax home, not to your entity setup, because everything just flows through from the limited partnership to the management company to the general partner, which are all flow through tax entities. Another question?
Hi, how are you? Before the tax reform of 2017, the sort of standard structure for a manager based in the U.S. with offshore investors was set up an investment management company in, let's say, Delaware or whatever, LLC, LP, and then offshore entity in Cayman or BBI, what have you. Has that optimal structure changed with the tax reform of 2017, or is that basically the same thing?
Good question. Chris, do you want to discuss that?
So, for the most part, what we've seen is the structure hasn't changed significantly. And that's still the standard structure. One of the things we do look at, and we will consider, though, is that question of whether or not the general partner to the fund should be a flow-through entity like an LLC or a corporation. And as discussed, that has a number of factors associated with it, location, holding period, types of assets. With most cryptocurrency funds, it hasn't changed because many of them are often actively trading, so they're constantly making short-term gains. There aren't very many that we've worked with that are truly long-based funds. And so the holding period of hasn't come into effect as much, and as a result, our structure primarily hasn't changed.
Great, thank you. Other questions?
Thank you for sharing. I have a question relates to tax and audit. I'm wondering, say, if I actively trade for 3 months or a year among different exchanges, and then once we needed to audit or we need to calculate like tax, like how this work, then we kind of just submit every trading record to like a service provider, and then they will help us calculate all the like tax we need to pay and make sure every transaction is legit. Like how this work because of the complexity of we trade around different exchanges, things like that.
Yeah, so super high level, basically you would work with a fund administrator to provide them all of your transactions during the year across all of the exchanges that you used. From a tax perspective, basically we would receive those files from the fund administrator, and we will calculate kind of your tax gain and loss based off of that, plus or minus any applicable tax adjustments. There's going to be book-to-tax differences that are recorded differently for tax than they are for books. Some of them are favorable, some of them are unfavorable. But super high level, from a tax perspective, we'll take information from a fund administrator, and we've definitely seen in the past probably year or so fund administrators becoming a lot more compatible to kind of extract that information and provide us a clean set of books and records for which we can calculate tax off of. So we basically are just taking your transactions during the year from the fund administrator and calculating tax off of that.
And let me say one more thing about using a fund administrator. With this area in cryptocurrencies, the need for an administrator, and a very good administrator, is much greater than a standard fund. So where in a normal liquid fund, you have a prime broker that handles all of your trades, in this space we have a combination of using exchanges and a crypto custodian like Kingdom Trust. And we have money going from the fund manager to multiple exchanges, all of which has to be tracked, and the need for protection on the side of investors goes up. And also, because of the true lack of custodianship, that's the best we have right now is fund administrators. And so a lot of people will overlook how important that role is. But for fund administration, there are multiple things that an administrator will do, one of which is really for tax purposes, but really that calculation of the net asset value, that reconciliation of the various fund accounts, looking at subscription documents as they come in, and telling a fund manager when they can take a distribution, and for how much is a very important role. There's also another service called the second signer service that would put the administrator in a position where they have to sign off on payments made, and that's something that can lead to more expenses. But these are the sort of things that absolutely have to be in place in order to give confidence to investors. All right. Let me go to some of the online questions. And so, Ian, for you, looking at the Cayman Islands versus the BVI, and any guidance from fund managers in specifically for cryptocurrency funds in deciding one way or another?
It's my favorite question. We have a very large office in BVI. We're the largest private employer in BVI. BVI and Cayman, the way in which they've distinguished themselves over the years is by championing different types of industry. Cayman has championed the world of investment funds. BVI's champion, for example, is the whole co-jurisdiction of choice globally. I would say that largely, when it comes to traditional hedge funds, that the market has spoken in terms of the sheer number of funds that are established in Cayman versus BVI. You've got roughly 11,000 funds registered in Cayman plus change, and there's around about sort of 2,500 registered in BVI. So roughly that's kind of how the split has been, and it's very similar when it comes to crypto asset funds. Now, there's no particular logical reason for that, because the laws of Cayman and the laws of BVI are very, very similar. I think that when you're choosing the jurisdiction, then you need to look to who your investors are going to be and where they're going to be located, and whether they have any jurisdictional preference of one over the other. I would say that if your investors are primarily in Asia, for example, you tend to find that Asian, particularly Chinese investors, they tend to have holdcos in BVI personally, so that they're more familiar with BVI. But then if they have other investments, potentially they are through hedge funds or private equity funds that are established in Cayman. So it's very much, the most important thing is for you as a manager is to speak to your investors and find out where they would feel more comfortable with the fund being set up. When you're working with the other service providers, they don't really mind which jurisdiction the fund is set up. Cost, there's a slight cost advantage with setting up in BVI. It's slightly cheaper on an annual basis when you're paying for annual fees with the register of companies, or you're paying for the vehicles that you've established annually, and when you're paying to the regulator, there's a slight advantage with BVI, but then generally that's overlooked. That's a fund expense as opposed to a manager expense. So the investors are paying, but generally Cayman has championed for the time being with the debate, but Cayman versus BVI.
Yeah. Also, another issue with a Cayman-specific audit being required.
So there is I would say that the laws in Cayman are they're constantly being updated and changed, and particularly, for example, when it comes to marketing in Europe, for example, the way in which the ESMA in Europe as well as the OECD has put more pressure on Cayman, particularly recently, and BVI has kind of got had more time to comply with certain pressure coming from that area, in order for both Cayman and BVI to be given the passport card under AIFMD in Europe, so that funds can market throughout the EU with a European passport. As a result of that, Cayman has enhanced its laws on AML significantly over recent times, and has also resulted in the Cayman Islands Monetary Authority having real teeth now to actually fine managers for breaching administrative regulatory rules in the Cayman Islands. So if you're not filing, for example, your annual audit, and in Cayman there's a requirement that you can either have your audit conducted anywhere in the world so long as it's signed off in the Cayman Islands by a regulated auditor, or indeed you can have your audit undertaken in Cayman and there's no sign-off provisions. But all of these things are designed to make sure that the fund is being correctly looked at from a service provider perspective. But certainly coming back to the fines, these are significant now. So for a minor breach, and SEMA has yet to give out guidance in terms of just what a minor breach will look like. But a fine there will be $6,000. There's then serious breaches, which again we don't know what they're going to be. But the ranges are $6,000 for a minor breach, and for a very serious breach, we're looking at $1.2 million and change. Now we've yet to again see what these are going to look like. But certainly, from my perspective, I don't sort of have sympathy there for managers. At the end of the day, you're a manager, you're a fiduciary, you've agreed to adhere to the regulatory environment of the Cayman Islands. That's exactly what you should be doing. You're required to have an annual audit. You've given a timetable to prepare it and make sure it happens. File it. That's what you're contractually obligated to do with your investors as well. So it's really tightened the jurisdiction significantly. And I think that cream rises to the top, and I think as a result of which more people will come to the Cayman Islands because it's significantly well regulated.
I would agree with all of that. It's a de minimis fee between Cayman and BVI.
Great. And we, I know there are some firms that have pushed the BVI side. Mostly with us, we set up a BVI fund when the client really wants to. But that's one of the things they're pointing to is that because of the Cayman sign-off, that was going to be a significant cost difference. I will say on a couple of things with Cayman, from client's perspective, I mean it's the most recognized name, and also certain ICOs that we've come across have had trouble with the BVI. Also, when looking at a cryptocurrency fund, there's so much that we don't know. There's so much uncertainty. So when in doubt, go with the standard, the more well-trod path. As legal counsel in this space generally, and as cryptocurrency fund attorneys, we don't like to be creative. We like to keep things really middle of the fairway. We like to do everything we can so that you can focus on the innovation of your investment strategy and not the innovation of your legal framework. That said, there's no true reason why why a BVI fund setup is any different than a Cayman setup from most
I think
perspectives.
from a sort of a DDQ perspective, when an investor comes in and is looking to make an investment in the fund, one of the questions where is the fund established? And if you're ticking a box that says Cayman or ticking a box saying BVI, it's absolutely fine. If it's possibly another jurisdiction, an eyebrow will get raised. But no eyebrow is going to be raised if the fund is being set up in BVI.
Yeah, and so just not to speak too strongly against one, but in general, it's a from what we know, it is a pure investor perception issue, and sometimes that perception is very important. And one thing to keep in mind for a cryptocurrency fund is we're talking generally about high net worth individuals and fairly aggressive family offices, and the sophistication level of the investors is an important consideration, because as you go up in size and in sophistication with the legal counsel that will be performing the due diligence, then I would say it becomes less important because these advisors know about the difference. But a lot of times these high net worth individuals, they hear things and rumors, and they want to gravitate towards what is common and known. The same issue we have with mini master funds. So a mini master is a structure that, rather than taking a offshore Cayman fund, an offshore feeder fund, we put, in this case it's a U.S. mini master. You have a U.S. fund and then attach a Cayman feeder to it. Well, my understanding is that from a legal perspective, things work out just fine. There's less precedent, but from an investor's point of view, they're wiring money to a account that is owned by a Delaware limited partnership. And again, more advanced, sophisticated people may realize that, that there are appropriate distinctions that the law can take care of, but for your average investor located offshore, that can make them nervous.
There can be a credibility issue there with the manager if they're establishing it that way. It works to a certain point. It works where you're raising less than $20–30 million, and you're really looking at making every possible cost saving imaginable. That's when it can work. But when the fund gets to a larger size than that, which is currently outside of crypto, at that point, you tend not to see the mini masters. But I would sort of say that with crypto, it's too early to sort of say whether it's a mini master or whether it's a master feeder. We're generally seeing master feeders being established.
Yeah, and that's been our take, is that in general, when a master feeder is set up, that's going to take care of most investors' needs. Now, there are the times when we would say a mini master makes sense from an emerging manager perspective, is when clients are not quite ready to set up the full fund, and the cost is significantly different. Then they can run as a domestic fund with the option to convert later, and that's doable, and we don't have strong opposition there. But we found it to be actually more important for smaller funds to make sure that across the board perception of investors are met, and they tend to be more sensitive to novel structures. I wanted to conclude with one more question, and that is a little bit broader, and it's to each panelist. And I would say, in your practice, what one piece of advice would you give to an emerging crypto fund manager looking to set up a structure and ultimately a fund in a way that would mitigate taxes and avoid liability?
So for a domestic-based fund structure, we primarily look to the Delaware limited partnership. One, because it's both friendly from a pass-through and tax perspective, as well as is very recognizable from an investor marketing perspective. From there, we then split, and we have two entities. We have a general partner that serves to oversee the fund. It collects that carried interest, it collects that performance allocation, and then we have a separate management company. Most of those are generally located and formed in the jurisdiction of the manager, primarily one for the applicability of the Investors Advisors Act. Also, typically all the income is going to flow through to that company or to that entity or that manager in general, and you can potentially avoid some other franchise taxes that may be applicable to certain states, which you'd have to pay then in addition to these income taxes coming in. That allows a couple of things. One, when you bifurcate the management company and the general partner, you avoid the opportunity for creditors to potentially attach and take income from not only the current fund, but potentially future funds, because each future fund would have its own potential, it would have its own fund entity and general partner. And so you protect yourself from creditors trying to dab into other funds if there's an issue with one. The other thing would be to contact and really discuss with council your strategy, so that we can understand and we can plan correctly for any potential changes that have occurred in the tax laws, securities laws, otherwise that may affect the jurisdiction, may affect the structure itself, the type of entity, corporation versus LLC, and potentially local tax issues as well. So we give you a broad base of all the potential issues to make an accurate decision on where we want to properly structure this fund that will best serve you and your investors.
Great, thanks, Chris.
Yeah, I guess just building off what Chris said, the taxation of these funds is very much facts and circumstances of that specific investment strategy, that specific fund. I guess advice I would give is just to, if you are one of those emerging potential portfolio managers, just to understand the costs associated with setting up a fund. It's very much so, especially in the crypto space, the fund administrator becomes a key aspect of it. You'll have your onshore counsel, your offshore counsel if you decide to go to that master feeder or mini master fund, along with obviously audit and tax work. As far as any specific opportunities for tax mitigation, it really just does depend on your investment strategy and what you're looking to accomplish in your fund. Buy and hold funds, you're going to be dealing a lot more with unrealized gain and loss, which is not taxable because you're not really selling anything. That's not a taxable realized event. If you are more of an active trader, there are certain elections you can make that kind of reduce the tedious nature of keeping track of all of the trades you're making during the year, which can help your bottom line. So I would say just understand your strategy and definitely consult with the people that you are hiring to see what the best optimization outcome you can have would be.
My advice is more generic. I would sort of say that if you're contemplating setting up a crypto asset fund or indeed any fund, you've got to be honest with yourself. How much are you actually going to raise as an initial launch? If you feel that it is enough to actually, set the fund up, then so be it. But think long and hard as to whether you're going to, maybe you've traded, your own monies and crypto, and now you're looking to expand that. But really sort of prepare your investment strategy, write it down, develop it, and really work on it in terms of just what it's going to look like. That is the first thing that we would ask to see, is just what is the strategy going to be. It's the first thing that the auditor will look for, and the fund administrator, so that sort of meaningful fee quotes can be provided by the other sort of providers, so you know just what you're getting yourselves involved with. And then timing, don't rush things. Make sure that everything is set up correctly. If it takes X period of time, that's how much it takes. Just because you've got people who are knocking on your door, desperate to invest the money, don't be tempted to just take it and set up something very, very quickly. Spend a lot of time with your counsel, spend a lot of time with your tax counsel, really structuring, making sure that everything is perfect from a an investor protection and also from a self-protection perspective.
Thank you. And to add to that, with the timing, is this has been a watershed moment for emerging funds. And one of the reasons that we're bullish on cryptocurrencies is not because of the activity of trading, but the sheer activity right now with emerging funds and what they're doing. And we end up, if we took on every client that is ready for us to start on their documents, we would be very, very busy indeed. We have specifically chosen to really analyze whether a fund manager, from our perspective, from the metrics that we are judging, whether they have the capability to not just raise the initial capital, but be able to then proceed along a pathway to being able to raise significant assets. The target clients that we have are those that are in a position where they can realistically get to that $50 million threshold within a few years. And if you're not in that position, we would encourage you to get involved with the Global Center for Investment Fund Studies. What we're looking to do there is have a place for the rest of the clients to go, a place where we are involved in research, in collaboration, a lot of networking. We're doing this really exciting research project with a number of students at Harvard, Columbia, Brigham Young University, and some students in London, where we are having emerging fund managers and students have one-on-one interviews with successful entrepreneurial funds that have successfully raised capital, and looking at what it was that made that work and what the key attributes are. Also, one of the biggest solutions to not being able to raise enough capital is combine forces. We're going to have an excellent presentation by a gentleman that's here by the name of Mike Loughton, who worked with was in charge of a fund that was specifically targeting undiscovered fund managers. So a fund of funds, and he'll be able to talk to some of those factors that make it possible to raise capital and talk about what the typical characteristics are of a successful fund manager. We're not seeking to be discouraging when we say hold off, you're not ready to launch. We're looking to try to make the managers successful in the long run, and sometimes that just means getting 5 to 7 fund managers together, pooling their thoughts and resources, and attacking it with their resources. But thank you, each of you, for participating, and we'll see as many of you online as we can on Saturday to kick off the GCIFS. Thank you.